Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this interview preview with Eric Parnell. We've addressed this a little bit. We're at the last few questions here, and we've in pieces talked about your investment philosophy, but could you overall summarize your investment philosophy and how that specifically looks as you build your portfolio?
Right. Well, as I mentioned at the beginning, I run an absolute return hedged strategy, or hedged absolute return strategy, and the design there is that I'm seeking to generate positive returns in all market environments, and part of doing that is I'm managing against risk first and then identifying what I believe to be attractive upside opportunities within that risk-controlled framework. So it's a top-down approach. So I'm starting with the economy first, identifying attractive sectors within the economy, within that economic backdrop, attractive industries within a sector, and then attractive companies within an industry. That goes to the stock side. But I also place an equal priority on all different asset classes, and stocks are just one of, 6 different completely differentiated asset classes, or 7, depending on the approach that I'm using. Completely differentiated asset classes. There are yield-producing instruments that have their own return, risk, income, and time horizon characteristics. There are investment-grade bonds. There are commodities. There are precious metals. There are hedge instruments, and there's cash. All of those components have equal importance in an overall investment strategy. And, the key is blending those different approaches into a overall investment approach that's designed to achieve that, returns objective within the risk-controlled framework.
And so tell me, how did you go about obviously I'm familiar with your approach and I've followed your work for a long time, and it's a very well thought out, very put together approach that brings in lots of different pieces. Some people may focus really specifically in one sector, but you're covering a lot of area. How did you go about developing this process? Is it something you kind of saw someone else doing and you made it your own, or has it just been you kind of piecemealing things together throughout your career?
I would say it's something that's just kind of evolved over time. One of the things that I always tell my students is when it comes to investing, identify the paths of investing that makes sense to you, that you're really drawn through, and embrace that and allow that to flourish so you can define your own investment approach. And that's really what happened with me. Throughout my investment career prior to starting my own firm, I was kind of born and raised, not only on, fundamental stock investing and intrinsic value, but also the importance of asset allocation in the long-term investment process, and how important asset allocation is in generating long-term returns and controlling risk. And, one of the things that I've never found acceptable in my view is to, allow myself or my clients to be subject purely to the downside risks that can be associated with any one asset class at any given point in time. I can't accept the fact that an investor simply needs to ride out a 50 or 60% decline in the stock market because that's inevitable over any certain amount of time. That there are always categories in investment markets, whether they are stocks or bonds or commodities or currencies or hedged instruments or anything else, that represent attractive value at any given point in time, and there are other securities that represent, an unattractive value, that they're too expensive. So don't want to limit my opportunity set to one category, but want to capitalize on the full menu of opportunities that exist across all asset classes.
And so the idea is that of all these different asset classes, you want to find the right mixture so that the correlation is very low. So again, like you said, stocks, say we have a 50% decline in a bear market, so a portion of your portfolio obviously will be impacted by that, but it's diversified enough that while one small class is impacted, there's a whole another breed of classes that you've been rotating into that are largely insulated or perhaps even do well in that environment, correct?
That's exactly right. One of the keys, and you highlight this point exactly, one of the keys to successful asset allocation modeling is an emphasis on correlation and cross-correlation between asset classes. One of the advantages that you get by investing beyond just the stock market is that you include securities in your portfolio that will zag when other securities are zigging. So, if stocks are going down at any given point in time, if you have a truly diversified portfolio, other areas of your portfolio will be going up as stocks are going down, and they will offset that decline. And hopefully those areas that are going up more than the part that's going down, and will maintain that positive returns experience. So it's that what you mentioned there is absolutely critical.
Yeah, and not easy to put together. And so, like I said, I've followed your work for a long time and have a lot of respect for the all that goes into that process, because obviously, if it was easy, everyone would be doing it. And I don't know many of the people who are doing what you're doing, which is pretty great. And I talk to a lot of people. Yeah. I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.